we had a very calm period of, very few 1% down days, very few 2% down days. I mean, there's been a lot of declines. I mean, we've averaged a 10% decline more than once every 2 years since World War II. About every 18 months, we've had a 10% decline in the stock market. About every 5 or 6 years, we've had a 20-25% decline. So I mean, that's the nature of the market. That's what you're dealing with. We just have had a very calm period for a sustained period in 2006 and early part of 2007. Now we're back into more normal times for the last 30 years. In the last 50 years, before this one, we've had 13 months where the market's gone down 8% or more. 13. Now, I think people would assume that a year later, after that month's over, the market's lower. Actually, 11 times out of 13, the market was higher after an 8% decline or more. So in bad months, generally 11 out of 13 times in the past, I'm not sure about the future, but that's been the past, 11 out of 13 times, the market was higher 12 months later after a bad month. Historically, trying to time the market has not been a winning pattern. They list all the really wealthy people in the world. No one's ever come up with one who was a market timer. And also, if you might be right on miss some of the decline. When the market turns up, it turns up very fast. In the last 50 years, if you missed the best 50 months, just 1 month a year, you would have had a return of about 3%, less than 3%. So if you just ridden it the whole period through, you had a return a little over 11. So just by missing 1 month a year, 50 months in 50 years, you turn a return of 11% to under 3. Staying the course has been the best thing to be. I mean, basically, if you look at the pattern time, jumping in and out is very costly. Usually make the wrong decisions, and you better stay the course. And you have to define the course. Is the course 5, 10, 15, 20 years, or is it 5 weeks? Is it 5 days? A lot of people think long-term investing is 4 weeks from Wednesday. That's not it. I think the most important organ in the body is the stomach. It's not the brain. I mean, most people, it's easy to say I'm a long-term investor, but it's the stomach that jumps in when you have all this bad news and declines, and your neighbors telling you stories, and you're on the way to work, and the market's down in Japan, and you're in a bad mood, and it's only 7:50 in the morning. That's when you say to yourself, heck, we'll get out of it. So, I think all the background noise is not productive. You just have to say to yourself, this is what I'm happy with the funds I own. I'm happy with and the market goes down, I might buy some more. I know I'm comfortable with outlook 10, 20, 30 years from now. That's where the market's been a good place to be. But I stay fully invested, and when the market goes down, I go down. I had a perfect record when I ran Magellan. The market went down 10 or 12 times, I was down 10 or 12 times. When it came back, I came back. I mean, the upside's more than the downside. So that's my philosophy. It works for me. I think it may not work for other people, but they have to have their own philosophy, and they have to know what the time horizon is. And they have to say, well, I'm comfortable with 25% stocks. I'm comfortable with 50% stocks. Or I want very conservative stocks, ones that have larger companies with dividend yields. Or I want really aggressive stocks. It's a person's own horizon, their own personality. People with long-term goals, such as retirement, when there are declines, if they're in a regular pattern of putting so much in a month, they're buying more shares in the market's down, and they're buying less fund shares in the market's up. They're actually reducing their costs, they're getting a better average. Mathematically, they're going to be better off in the long-term horizon if they're buying more shares in down markets, less shares in up markets. That's the benefit of regular investing for retirement. Same amount every month, same amount every quarter. You'll take advantage of declines. Diversification is an important thing to have, as long as it makes sense. I mean, if you have 10 funds and they're all emerging growth funds or all emerging market funds, that's not diversification. So people might have a lot of different funds that have the same theme. You want to look to see, this is what I'm comfortable with. Understand what you own, know what kind of funds you're in, know what kind of stocks you're in, understand it, know that we have recessions periodically, and we also have downturns. Surprises come out of left field that no one would expect. And you have to say, I'm comfortable with what I own. If it goes lower, I'm fine. If I'm not, you should spend some time and review it. come to Fidelity either by phone or come to our office in person. We can do a total portfolio review for you. We can go over and see what is your risk tolerance, what are your goals, what are your financial needs over the next year or the next 2 years. So what are your financial assets? We go through a system. You'll be content. You'll be happy when you go through this process. I think you'll feel more comfortable. May make a decision you'll be pleased with. At least you've thought it through.